we often, within our executive group, when we're looking at a potential ground up development, sometimes it comes to us already with the bones in place. Sometimes someone will pitch us, they'll own the property and they'll want to JV with us, right? They'll want to contribute the land into a joint venture relationship where they're going to sit on the Class A share common equity side for the value of the land. But a lot of times they've already done the preliminary things. They've already gotten a plat. Maybe they moved it along a little bit. They've already reached out to certain banks, lending institutions, done some underwriting, some analysis on what the project should look like. And then they realize they can't do it. They either can't get the capital stack together or they don't have the expertise, operational or otherwise. And so they'll come to us. So a lot of times the bones, the skeleton of the project's already kind of preformed, and there's been some underwriting done and some analysis, and we'll look at it and we'll see whether we want to do it. And sometimes if we have we'll have a suggestion, we can do something different with this. And sometimes those folks who want to contribute that land and be a part of it with us are happy with that because they just want to make money. Other times they disagree with us and the deal is only going to go forward if we kind of follow their idea for it. And so we get a lot of that. Other times, though, there's just a piece of land that's being sold and there's no contribution. We're just going to acquire the land and we're going to do what we want with it. But of course, the location dictates in a lot of ways exactly what you can and can't do with it. Zoning, how difficult is the process to get a change in zone? What are the politics of the local city? If you're we're in a city where I live in Friendswood, Texas, and you're never going to build a building over 4 stories here. It's just there's no political will for that, right? There's a certain look and feel they want for that. And you're not going to be able to build a certain type of hotel in the city because they have certain requirements as well. And so politics, location, geography, what the market's currently doing, all these factors weigh in. And then, of course, there's our strike zones, our areas of expertise. We are really heavily weighted towards hospitality. We do hotels all over the place. We've done it for decades. We like doing other things. We've done some multifamily. We've done apartments. We've done, shopping centers and things like that. And we like those things as well if the return profile is proper for it. But a lot of times we have an idea in mind. We want to build a hotel. We want to look for it. And so we're trying to find a land that matches something that we want to do. We were approached by our general contracting partner, someone we've done work with in the past. He had the property under contract. And so this was a site that was already targeted by him. And the background on this is the West Gray area, West Gray Terrace, the Montrose neighborhood, is a beautiful area in a suburb of Houston. And we've kept our eye on it for a little while because Houston is growing. It's one of the largest growing communities in the country. It's just recently there was an article in Fortune magazine that talked about the 5 fastest growing, areas, and Houston's one of them. They always talk about the classic. You always had New York and Los Angeles and San Francisco. They're saying there's 5 now that are eclipsing those, and Houston's one of them. And so there's a lot of sprawl, and it's bringing in. There's industry, there's medicine, there's education, there's oil, petroleum, and then there's space and aerospace. NASA's, located just south of Houston. And so there's tremendous growth that's going on. And so this neighborhood is an exclusive, beautiful neighborhood that's starting to see the growth of people moving in here, and they want condos. They want luxury condos with shared amenities. And so we've seen these projects going up. And so when we had an opportunity to get involved on this particular land, I can't think of anything better for that particular project. So the location and the opportunity just played to a mid-rise luxury condo like nothing else really would in this particular area. When you're looking at building a condo, like a series of condos, there's a number of ways to do it. One, of course, is you can let the end user, the person who's going to buy it, come up with the ideas of what they want in there, just a true custom build. That can be more difficult because you can deliver a better product. Maybe you give them 3 or 4 floor plans, you give them some ideas, some options, but you kind of want to limit it to about 3. It makes it easier on the build. It makes it easier on the delivery. And so that's one way to do it. And then, of course, there's high-end, really high-end, amenities. We're talking about fitting and furnishings that are just beautiful with appliances that are name recognized everywhere. And then there's low-end where you're just pumping something out. And then there's something in the middle. This particular area, because it is going to be a luxury condo, we do want to have name recognized brands. We want to have like Viking appliances or something that everyone will recognize. It's a selling point. It always is. People ask what type of appliances are going in, and we want quality finishing throughout the condo. There's no other way you're going to sell luxury condos and compete in the market without those types of things. So this particular product, because it is luxury in the location that it's located at and the price point that we're going to be selling at, you're not going to be able to get away with skimping on the type of amenities and the type of interior furnishings. And so we're doing a luxury product, and we're going to have appliances and furnishings that match. What's the footprint going to be? Are we going to go 1 bedroom, 2 bedroom, 3 bedroom, penthouse suites? How many of those should we have? Like on the West Gray product, the very top floor, we do have a couple much larger units, the penthouses. Why didn't we do that on all of them? And why go 1 bedroom? Why not go 2 bedroom? Right? These are the questions. And how big of a footprint? And so we really rely on market studies done by sales professionals. So we often will turn to like Sotheby's, for example, and they're going to want to be the person who lists and sells these units. And so they want to partner up with us, and they're willing to give us tremendous amount of market research that they've already done. They can look at all the things that have sold in that area, what the demographics are like, what are people looking for, what is the best price point. And we gather that data when we make a decision on how big are we going to do this, what's the density going to be, right? How many units are going to go into this, and what's is it going to be 1 bedroom, 2 bedroom? What kind of people are we going to have move? There's going to be families. Is it going to be upwardly mobile professionals, students? The location, of course, is going to drive it. But we really rely heavily on market studies and market analysis done by sales partners who want our business, who want to work with us. They're very forthcoming with that data. They want to prove themselves that they could be a good partner and help us create the best product. Our construction expert, but he'll give us a list, and these are the price points, and these are the name recognized things. And so, there's certain things that everyone knows. Viking, everyone knows Viking appliances. Sub-Zero, everyone knows that a Sub-Zero refrigerator and freezer combo is going to be top notch. Those are a couple that just jump to mind. And there's other ones that come from Europe, types of granite, types of marble that are sourced from Europe that people who are into these things really recognize immediately. I wouldn't necessarily, because I have too many children, so I get stuff that's durable. But yeah, I rely on our construction guy to kind of give us our options. And sometimes when you're choosing between luxury name recognized brands or finishings, another question is, is this stuff available now? What's the timeline on it? What's the deliverables? Where are we going to source it? And so these things also factor in. And so getting a high quality product, but one that you can deliver right away and at a great price point. Maybe we have relationships, maybe our construction guys relationships on some of these things. And so there's a number of factors that go in there, but you want to provide the product that will sell at a price that makes the most sense, and you can deliver when you say you can. So, I mean, I don't know that necessarily we've been struck with that misfortune, but I have seen it anecdotally and talked to other people, and even talked to our sales partners when they say, if you price it out of the market, you're going to have real difficulty selling. And there's people that put out there there's builders who love to build amazing products. It's like to their legacy, right? I built this amazing thing, but if it doesn't sell and it sits on the market forever, then was it worth it? And so we're very sensitive to that. You put your name on something, and you're the developer and you're the builder. You want it to be awesome. But if the land that you have and what you're working with and what the buyers, what their profile looks like, sometimes you just have to go with that. And that's the only way you can really do something like that. Especially if you're a fiduciary of other people's money. You're raising money. You got to spend it in the best way. You can't do a testament to yourself. You can't build something that other people will walk by and say, yeah, that was Wolfgram that built that. Isn't that amazing? Doesn't help if it sits, 30% occupied for years. And so, yeah, you can definitely mess that up. And so that's, again, how do you get that data? How do you know? And then you really have to rely on the professionals, the people that are out there selling every single day, walking through units, similar, comparable units every day, talking to people who are closing those sales and what the sales velocity looks like. That's the real data. That's where the rubber meets the road. And so we rely heavily on those types of market analysis and reports. It's real simple, right? We're going vertical on the build. And so there's going to be a total of 7 floors. And so you have a stacking plan. It's just a schematic, it's a diagram that shows you what each floor is going to look like, its footprint, its blueprint, so to speak. So on the very bottom, you're going to have the parking substructure, another level of parking. The third level is going to be all the common amenities. and it's a diagram that shows what it's going to look like. It's two-dimensional. And so we have a number of slides that when we're talking to our investors, and of course, when we're talking to banks and lending partners and other people, they want to see what the product's going to look like. They want to see the stacking plan. The stacking plan is just that. It's just individual slides, diagrams that show what each floor is going to look like. There's a couple considerations, right? Once you go beyond a certain level, the price gets more expensive because, there's certain options that, we talk to our contractor and they'll tell us, once you start going above, let's say 7 floors, then there has to be additional foundation support. There has to be different pillars, there has to be different support. And then the price goes up. The price for additional floors goes up. And so sometimes you're just kind of dialing that in right. But you're right. Of course, when they actually design the build, you want the plumbing to be on top of each other. You don't have to do long runs of piping and plumbing. And so construction professionals are very savvy to this when they're dialing in their bids and their project with the best way and I guess that is part of the stacking plan. Like it gives you an idea of how things are going to be built on top of each other to minimize cost and expedite the timeline for the build. We have a number of condo hotels. So we own the Waldorf Astoria in Park City. It is a condo hotel. We are building a second wing that'll be dedicated hotel rooms, but the Waldorf we own now is a condo hotel. And then across the street from them, we're working on another Hilton branded condo hotel that we're about halfway through the build. We just poured the other day, and that's going to be a condo hotel, 129 rooms, condo hotel. And so this luxury, so it's a luxury condo. Of course, we expect that the buyers, because it is Park City, the buyers are not going to live there full time, that they're going to put their units into a rental management pool, which will operate as a hotel. It will look like, to the end user, it will look like to customers, it'll look like a hotel, but they're condos and it has common condo ownership, and they'll have the condominium board and have all the things that go with a condo product. So we have a lot of familiarity with building these things and managing condos and selling condos. And sometimes we have it mixed with the hotel. So a portion of them are sold as condos and a portion of them are kept back or retained by the company. But typically we like them to participate in a revenue management pool when they are being used as a hotel. But yeah, it's very similar to hotels. We typically think of it as being broken down into 3 or 4 phases. The first phase, of course, is land acquisition, right? Being able to get the land, acquire the land, source it, do our due diligence, do our phase 1 environmental study, do the other third-party reports. Banks require them anyways, but of course someone who's going to buy it, want to see those as well. Title analysis, title surveys, title commitments. This is the preliminary things that go into the first phase, which is acquiring the land that you're going to build on. Sometimes there's structures on it, and you have to also plan on raising those structures. The second phase is architectural and engineering, the plans, right? You're going to be submitting plans to the municipality that governs those things, and those things take some time, and they can be pretty expensive. The engineering, and like for instance on West Gray, the architecture, the plans for both that and civil engineering are going to cost close to $1 million when it's all said and done. But of course, that's the bones. That's what everyone's going to build on. That's what's going to get approved. And then there's the actual build, and that's the third phase, the actual build. We're going to compact the ground. You're going to bring in the utilities. You're going to pour the concrete. You're going to raise the structure. And the final phase, which actually overlaps because we're going to start selling along the way, is the divestment phase, where you sell the actual end product, and hopefully you along the way you build a model unit. Our sales partners tell us if we can build a model unit or 2, depending if there's like some significant differences between what we're selling, that they can take potential buyers and walk them through it so they can actually see, and touch something tangible. It really juices sales. It expedites the sales velocity as well. So we always try to build a model unit right away as we're building the rest of the structure. But that's the final phase, is the divestment, the sale of the product. And that starts long before we've built the product and we start getting those pre-sales in place. In phase 1, it's an environmental study that's done on the property, right? And so it's a preliminary study that is done by the experts, a third-party expert that you hire to do the phase 1 analysis. And they go and conduct an analysis of the property, the soils, other things. It's a preliminary look to see if there's any red flags that get raised. And they also do some background. They do background checks to see what the use of the land was. what it's been, if it was at one time owned by an oil company, let's say, then they're going to look to see if there were dry wells. There's going to look and see other things. They're going to check for potential contamination. So their analysis is not only in the history of the property, but also some on-site stuff. If something gets flagged, if there's something significant, then you want to do a phase 2, which is a much more deep analysis of the environmental conditions on the property. And something, it might, based on the results of a phase 2, you may scrap the project entirely, because you might be getting into something that's going to be very expensive, and even something that might result in a terminal event where you just can't finish the project, and you just got a dead project on your hands, and no one wants that. And banks will also look at the phase 1, your lending partners, anyone who's the land's going to be their collateral and security, and they'll determine whether or not they need a phase 2 as well. So it's an environmental study. So there's strict liability that runs with the land. So you are responsible to make sure that you understand the property that you're buying, especially when it comes to these contaminated areas. You can't, and even if you were to contractually sign something where someone said, I am buying this and I will take all personal responsibility, or the seller says, I will retain all personal liability and responsibility for the conditions of the land. Well, guess what? You may have a claim against them, an indemnity claim, but that does not work against a governmental entity or someone else who gets sick or somehow suffers on that land. You are responsible as the landowner. You cannot divest yourself or divorce yourself from that responsibility. It runs with the land, and it's strict liability. Now, you can't have clauses that require the seller, the previous seller owner, to indemnify you, so you can go after them to pay you what you had to pay out. Hopefully they're liquid. Hopefully they're around, right? And oftentimes when we're negotiating these agreements, we'll ask people they'll make warranties about the condition of the land. They'll covenant, and we'll ask that those covenants and warranties remain active after the close for a period of time. It's something that we negotiate 1 year, 2 years, 3 years. Depends on how badly they want to sell and what they're willing to commit to, and how questionable, perhaps some open questions about the property, the condition. But yeah, this is a big deal. You have to make sure, something becomes a Superfund site and then you're just dead in the water. If it's saturated with oil, petroleum products, it's a big deal when people buy gas stations, for example. And so, or has other industrial use. You don't know where they were dumping out, chemicals and other products. And so whenever it's that kind of thing, you're pretty much always going to do a phase 2. If it had previous industrial use, depending on the nature of it, you're going to really want to do a deep dive. Sometimes if you're on a site that you're going to do a big development on, you're going to want to do what they call cultural research management. And that's, you hire an archaeological company that's not like the Indiana Jones type of archaeology, but they'll go out and do test sites. They'll do test digs just to determine if there's something archaeologically significant that might arise that would shut down a project. And so it's really interesting the way they also have phases. They'll do every 25 feet, they'll dig down 3 feet, and they'll pull it up and they'll sift it in their little sifters and see if there's anything archaeologically significant. And then if they start finding something within a certain ratio, then they now half the distance and go 6 feet, and they have a whole process for that. Usually big developers who want to do big, multiplex, many units, numerous anchor tenants, something like that, in an area that has some history with, like maybe previous Indian civilizations or native indigenous people. They'll do those they'll always commission that kind of a thing before they ever get going. So Superfund site is just a site that's been designated in something that is has some serious contamination issues, and there are resources that can be available to do it, but it falls into a bracket. And so it's very difficult to get things built. You have to clean it up. You have to restore it. You have to go through a process. And so it's something you just don't want to touch. I mean, if you came into the land, if you inherited it and you got to deal with it somehow, then you have to deal with it. But someone from the outside, you're not going to buy into that. It's just not worth the headache, unless they're selling it so cheap because of that. And, there's a price for everything, right? So obviously you have to get land entitled. And that means that you have to have it zoned property or subdivided or platted, depending on what you're doing with it. And so we look at something, we determine what the current zoning is. And this is something you talk to local developers. If you're not familiar with the area yourself, it's nice to talk to, like, for instance, on the Westbury area, we talked to a person who was a member of the building commission, and literally just asked them, are we going to have any problems if we try to build this here? And he said, absolutely not at all. In fact, the city wants that. You'll get a lot of political support for that. And so you have to look into, like, are we going to ask for a zoning variance? That could be difficult. What are the politics behind that? And then also it's going to affect when you look at a return profile for investors, how long does something take, right? I mean, it can take 2 years, 3 years in somewhere like San Francisco or somewhere like Los Angeles. We've done a lot of stuff in the West Coast, right? Our company came out of California, and the politics there, you can go to public hearings and you can have a few vocal people, and all of a sudden all of a sudden the city council is very nervous about it and worried about it, and they're worried about the optics, and who knows where they are in their election cycle, and all of a sudden the thing gets derailed or tabled. And this can be tremendous. It's a tremendous risk because time is money, and if you can't move forward for 3 years, the IRR, right, the return profile is which is time sensitive, is completely out of whack. And so this is something you look at very carefully. Like, how is it currently zoned? What can be done there? If we have to seek a zoning variance, how difficult is that? What are the politics in the area? Let's talk to people who've been doing this. Let's talk to people who are decision makers, right? You have to be very careful, no quid pro quo, but you can talk to, depending on the rules, you got to look at the rules for the jurisdiction. For instance, in my city, you can talk to a city council member. You can talk to someone who's a member of the Planning and Zoning Commission. You can't do more than 2 of them or 3 of them together at the same time. They have these certain rules, but you just figure that out and you do your due diligence. But it is a big risk, right? If you can't get the right zoning, if you can't get the right entitlements on the land, then you can't move forward. And sometimes, we looked at a property that there was some ecologically significant things on, and we just decided we're not going to do it because of that very risk. The risk was too big. That's just when something's zoned. So for instance, we're working on a project right now where we need to seek a change in the zoning. It's currently zoned for semi-public and private use, some residential, and we need to have it mixed use, which is a different zoning category. So we can do the project we want to do. And fortunately, we have a lot of support. In fact, we just had a 6-0 vote from the city council 3 days ago to approve it. But we knew that beforehand because we had talked to people and the city was behind it. In fact, the city is going to provide some bonding for the project because there's so much behind it. But yeah, that's what a zoning variance is where you want to do something in a zone that's not otherwise zoned for it, and you want to have that change in zoning. That's what they say, but it's not actually true, right? They don't have a typical zoning. In fact, all of Texas. That's what it tells. Texas doesn't really have zoning. But it's not true because they create public utility districts, right? And they do tax assessments. So as you know, state of Texas doesn't have personal income taxes, and they use a variety of other taxing mechanisms in order to raise. All governments have to raise taxes, and so there's property taxes, and there's a lot of MUDs, right? Municipal utility district taxes, and there's school district taxes, and so that's where the kind of zoning comes in. What type of district is it? How are the levies and assessments going to go on? Some can be levied, some can't. And so you have to get approval, right? It has to get through the P&Z commissions. And so that's where we use zoning loosely sometimes. And sometimes someone might be a more pedantic approach and say, oh, well, technically it's not zoning, but it's what we're talking about. It's the use of the land in that particular area. Acquisition can be as easy, if someone's selling a piece of property, if it's on the market, right, you can enter into a purchase sale agreement. If you have your financing ready to go, I mean, seller would be happy to sell it in 2 weeks, right? But typically what we like to do is we need to do due diligence. That's one part of it. Sometimes we have to raise the capital as well, like we are in most of our offerings. So we need time to put that together. But we also want to do our due diligence. We want to be exploring the ideas of zoning. We want to be exploring the ideas of what the sites there are going to be any surprises to us. We want to test the ground. We want to do other things. So we'll typically draft a purchase sale agreement that will have 90 days, sometimes more if we can get away with it, for the due diligence period before the earnest money goes hard. And then beyond that, 30 or 60 days for the close period, maybe with a built-in extension for letting a little more earnest money go hard. So we like to have enough time, enough run-up time to be able to close the deal on the acquisition. So that, like I said, that piece of it can range depending on what you need. The engineering and the architecture depends on the site, depends on how big the project is, but you're talking a minimum of 4 to 6 months, a maximum typically of a year. It doesn't usually take longer than that. And then if it's a decent sized build, we always just pencil in 24 months. You can do it quicker than that, but once you break ground, you just plan on 24 months to completion. And then of course sales goes along the way. You can pre-sell everything if you have the right approach and you have the right product. Otherwise, like in our West Gray thing, we only say that we're going to sell, less than a third of them in pre-sales, and then we're going to have 2 sales per month thereafter until it's completely done. We think we're going to go a lot faster than that. Some of the comparable products that we're looking at have sold everything but 9 units before the foundation's even raised. For example, London House is a luxury condo that's very close. It's just a couple minutes from the product that we're building, and on their website is they only have 9 left, and they haven't even raised their foundation. So we're pretty certain that we're going to crush our own conservative estimates, but that's the way we build. That's what we figure as far as a timeline to be conservative. So typically, like, it's going to be, we just say 90 days, and there's usually no difficulties in the entitlement process. It can be, because typically what happens is you get a preliminary plat done, right? Especially if you're leading up to it. And when I say 90 days, I'm talking from the time that you first submit to the city, because they're going to look at it. It's going to go to their committee. The committee's going to vote for it. They're going to set it for public hearing. Depends on how small the city is. How often do they even have their meetings, right? If they have a meeting only every 2 months, okay, maybe it's going to take a little longer. But these things usually, unless you're doing something that's controversial, unless you're doing something that might generate some pushback, there's really Texas is very favorable towards business in general, and towards building and developing and growing. And so we haven't had any problems in any of our projects in Texas. It goes pretty quick. Of course, there's other components to it, right? If you're seeking financing from the city, like through a bonds package or TERS or something, or if you're creating a brand new PIDS, like a public infrastructure district, then that can maybe take a little longer. But even the one that we're working on right now, we have a project right now that we're working on in South Houston that has a $50 to $70 million bond for the development of 100 acres. And it's a 3 to 4 month process. And it's amazing how fast things move. And it's been great. And so there is, I guess, worst case scenarios. We haven't run into them in Texas where you get pushback, where there's politics involved. You're cutting down a bunch of trees. You're trying to move a cemetery or something. And so, fortunately, we don't have any of those issues with what we're working, and we don't even consider. We put it very low on the risk factor that we can't get something entitled or platted properly. TIRZ is a tax incentive reinvestment zone, TIRZ, and it just allows a city or municipality to do is to go and raise money, like to go to a bonding company. They'll reach out. There's bonding companies out there who have their own suite of investors who will put a bunch of money. They'll deliver a bunch of money to a city. That city can then offer the developer to build something that otherwise may not have been built because maybe the economics aren't there. And what they do is they calculate, once the developer builds, once he puts whatever he's planning on building, and they have a development agreement and there's a plan and they know where it is. Once he puts value on the ground, it goes vertical, and then it increases, of course, the tax revenues that are coming to the city. They just figure out what are those tax revenues going to look like? Can it pay the bond over time? And so it's a way for the city to get upfront development money to a developer to get something done that will be better for them in the long run and over time, because now there's a bunch of value on the ground that's generating taxes to the city. So it's just a thing that's developed. We do preliminary mock-ups, right, early on, because part of it is you're going to be pitching people to raise money for it. You want to have something pretty. You want to have something that shows you what it's going to look like. It may not be down to nuts and bolts, but it's the general idea of what it's going to look like. And so we'll typically commission those. We actually have a company that's out of Argentina that can turn them around in 30 days, and they're beautifully drawn and fairly inexpensive for just these schematics and these mock-ups. But we don't we don't pay for the full suite of civil engineering documents and architecture until we're committed to the project. We know we're moving forward. Whether or not we wait, we typically in Texas, if depending on what the nature of the product is, but on this product, we wouldn't wait to have that done to get some sort of approval, permitting from the city, because again, not controversial. Like the West Gray is in a residential area, and we're putting a residential product on there, and there's just no real concerns here. And the city actually would be thrilled to have us take the kind of dilapidated structures, the older structures that are on there, and then replace it with a beautiful brand new, luxury condo in that area. So we don't have any concerns there. I could see making a judgment call that if you had concerns about the entitlement process, not spending that money until you got that done. So it depends on the nature of so if you know the city manager and you understand city council and the planning people, sometimes you can socialize what we call socialize the deal with them previously. So you do some preliminary stuff, the drawings. You're asking, this is what we're planning on doing here. How did the city feel about the municipality? Do we have any pushback? And they'll give you good feedback. They'll say, hey, just make sure, the water table, water mitigation, you have to do X, and this is the drop per acre, and this is the saturation. And they'll give you good feedback because that's their job. And then you're going to need that data anyways. It's going to feed into your plans. How much water we deal with a lot of flooding and water issues, right? Being so close to the Gulf, it's a big deal. And so water mitigation is a huge thing, and detention ponds and retention. And can we build something underground? Where do we funnel it? Can we tie into the city sewer systems? And if so, at what fall rate? And so these are things that we have. So when we're socializing the deal, we have to have some preliminary plans, right? In order to get the good question, to get the answers to the questions that we need to understand what what it's going to cost. And we need to know what it's going to cost, or be pretty close to dialed in, because we're telling investors, this is what the project's going to cost. This is what you're buying into. This is what your return profile is, right? If we were all doing it in-house, then we could be more fuzzy on that. So there is like this balance between having to spend some money to know exactly what we can deliver, right? It protects our reputation, and it's honoring our fiduciary relationship to our investors, and just being good general partners. And so there's this like there's a dynamic flow here. Spend a little more to get a tighter understanding of what the project's going to be, but you don't want to spend too much because you might abandon the project. When we raise money, of course, we don't break in pounds. Money sits in an escrow account until we reach certain metrics, and otherwise we just deliver the money back if something happens. We'll say we can't move forward on this project. But yeah, we don't get the full suite of stuff until we're entitled. Civil engineering, architecture are expensive. Obviously the contractor, right, is who your GC is going to be is expensive. Other things you have to have expertise on, you get it early, very early, is your insurance folks. You need insurance on everything, right? You need insurance, you need bonds, so like knowing what you're gonna in your contract with your general contractor, you're gonna have obligations in there of what type of insurance and what amounts they have to carry for the project. You need to know what that is, and then so the insurance partner, and we have a very good insurance partner that's basically in-house, because we try to go vertical with a lot of our stuff. Myself, I'm a practicing attorney, I'm the chief legal officer, but our CEO, Phil Wolfgram, went to law school. Our COO, Chloe Wolfgram, just graduated from Yale Law School a couple of years ago. And so we can all wear different hats within our group. But so the insurance, architecture, engineering, the cost of the build, and then below that, of course, there's all the different subs. Some subs are more expensive than others, and then just the pricing of things. And then so those are the big ticket items on those things. A lot of times we do the GC in-house. So one of our key players, one of our team members, is Kurt Stedham, and he is a general contractor and has been for more than 3 decades, and he's done everything. He's fantastic. We've been working with him for decades and decades and decades, and he's built everything, and he's fantastic. He keeps eyes on the project. So he is our number one facilitator when we work with. Sometimes we can do it completely in-house, where he acts as the GC and the project manager, and he's keeping an eye on it, and it's all the subs carrying out the work. A lot of times we do have to hire a general contractor, depending on the size and the nature, scope of the build and where it's located. But then Kurt will keep an eye on the general contractor, right? We'll enter into a GCM, a GMP, right? The gross maximum price, which we like those contracts because they can't submit change orders and just say, oh, it costs more. This is they're guaranteeing it basically that they can deliver this product for this price, unless we mutually agree on some sort of change order. And so, but how do you dial that in, right? I mean, how do you make sure that the markups aren't unfair? You can go to a bidding process where people are competitive, of course, when you get closer to true market value. But it's great having an in-house construction guy that we trust, that knows that he can look at these things and cut right through all the fluff and really keep an eye on the bottom line. And so typically we'll act as developer, we'll hire a general contractor. Our in-house guy will be the number one liaison with that person and really keep an eye on it. If it's a smaller build, we can act as general contractors ourselves and save money, and our guy can just work directly with GCs, with subs, I mean. Pre-sales are when you go out to the market and you say, this is the product that we are building. We're going to be breaking ground on such and such a date. We believe that we'll be able to deliver the end product in this date. And we incentivize people to get in early, right? Because they're going to get a better pricing than when we get to the finished product. And so there are folks out there who say, I really want to live in this area. I would love to live in the hottest, newest luxury condo in the West Gray area. It's right on West Gray itself, front facing. I can walk to all these clubs and the restaurants. And it's just such a walkable. This is beautiful. I want this product. And the timing is right for me. Maybe I'm in school and I'm going to be graduating in 2 years, and so I don't have to complete the contract and close for 3 years. That's perfect for me. So there's a market out there. And so pre-sales they just enter into the contract. They sign the contract. They pay a percentage, maybe 10% of the money that goes down. And of course, and it goes hard. Like, typically we'll have like a 90-day period where they do their due diligence. There's not much to due diligence on, and then it goes hard. We have to return it if we can't deliver the product. Of course, we would be in default if we did that. And in Texas, unlike in Utah and other states, we can't use the deposits as part of the development budget. It has to sit in an escrow. But it's good because you get the sales locked up and this is valuable to us to know what, to keep an eye on where we're at and how many we need to sell and where we need to turn our efforts. But those are the pre-sales. And it's really nice if you can get a lot of pre-sales done, because then you're ready to close as soon as you open. As soon as you open, you're ready to close, pay off any debt that you have on the construction loan, on the acquisition loan, and not have those carrying costs. And so it's really very valuable. It depends. If you need an extension on the construction loan, for example, right? And you're going back to the debt facility, to the bank or the debt lender or whoever, and you're saying, hey, we'd like to get an extension on this. They want to know, where are we at? And having a whole bunch of pre-sales is very valuable to them, because that's how they're going to get paid back. And so, yeah, very helpful there. It's very helpful to do that. Or if you have to raise more equity, for some reason, you don't want to increase your debt and you want to raise more equity, it's a great thing to say, here's where we're at, and we already have all these pre-sales. This product is going to sell. This product's great. We have a lot more certainty in what our return profile looks like. And so, yeah, it remains good for the capitalization of the project. You never know when something's going to come up. Happens all the time. You need an extension. You need to do something else. You maybe midway through the build, you decide, hey, you know what? Why don't we build another floor? Because things are going so well, and we're going to raise a little more equity, or we're going to increase the amount of debt in the construction loan. And so these things are valuable. Not only that, but sometimes you're telling your construction lender that we're planning on doing pre-sales. Here's our estimates, and you're taking draws from them. Well, they want reports. They're going to keep an eye on it, and so being able to report to them and say, here's where we're at, and we're exceeding expectations, or these things are valuable too for that relationship. And a lot of times you're building relationships with. We continually go back and use some of the same debt lenders because we've had great relationships with them. And we have some, for example, we've done several hotel deals where they say, we know you guys are you're the in club, anything, bring everything to us, because we've already underwritten you and you always perform so well. And so we're sitting, ready, because they have to deploy capital. They need someone like us, a trusted partner that can execute. They're always looking for that themselves, because on their side, that's their business. And so these are win-win scenarios. And so, being able to, to develop these relationships is important. We've never done that. And I can see a future where maybe there's an arbitrage play. There's some sort of providing some sort of capital in some way to these end buyers that might make sense. But no, we don't provide, we're not debt lenders, and we've never done that. We haven't done that on any of our condo projects to date, but we have talked about things like that, right? Especially if you have a product that might be a little tougher to sell, and you want to work out something that will assist in those sales, and you have a lender who's amenable to that and would like to get that kind of business. But we haven't done that yet, and we don't have that relationship on this project. I do tell people that commercial real estate, there's all these different investment baskets you can be in. There's stocks, and there's bonds, and there's crypto, and there's a variety of things out there, and you can put money into like angel investing and true startups, and there's tech startups, and some of those things just make a fortune for people, but it's like 1 out of every 12 actually pays off, but when it does pay off, it's huge. And so we talk about these things, but commercial real estate has outperformed everything over the long run. It's real, it's tangible. I love commercial real estate. I like that product. The land appreciates over time when you're holding it. And if you have good operators, and we pride ourselves on being good operators, we have a great management team. So we're Wolfgram Capital, but we're also Wolfgram Properties, which is our management arm. And we have 1,000 employees because we have employees in hotels and everything. And we just have tight operations. And our CEO, Phil Wolfgram, has done operations for 30 years. And we really pride ourselves. In fact, a lot of our purchases will be with an eye towards, are they running it properly? Even if there's no value add, we can't build anything new. It's already built, but we think we can go in and we can tighten up operations and therefore increase the NOI, right? The EBITDA number, and therefore increase market value. And we've done that over and over. We're good operators. And so I always tell people, commercial real estate is fantastic to be in. Land values appreciate. We can put value on the ground. We're good at operations. And so I just suggest that even if you're doing other things, have a component that you're investing in commercial real estate, because over the long run, it has outperformed everything.